Most people think the biggest lever in personal finance is how much they invest. It's a real lever, just not the only one, and often not the first one, that actually needs pulling. Pay off debt, build an emergency fund, invest early, get insurance, increase your retirement contributions, track your net worth. Every piece of that advice is correct on its own. Almost nobody tells you what order it actually belongs in. And getting that order right is one of the few levers in personal finance that costs nothing extra to use. Two people can earn the exact same income and work through that same list of moves in a different order and end up in meaningfully different places within 18 months. Not because one of them earned more, but because one of them did it out of sequence. This is the checklist that fixes that. 10 steps, in order, covering everything from your first $100 to the habits that keep wealth once you've actually built it. You don't need to do all 10 today. You need to know which one is next. One ground rule before we start. Order matters more than speed. Doing step 1 well is worth more than doing steps 1 through 5 badly, all at once. Each step is built to work because the ones before it are already handled, and skipping ahead often means solving a smaller problem while a bigger one sits unprotected. This is a general framework, not personalized advice for your specific tax, insurance, or investment situation, and several steps genuinely benefit from a conversation with a professional who can see your full picture. All you actually need to get started is a bank account, access to your pay stub or benefits portal to check for a match, and about 30 uninterrupted minutes. Step 1. Build a starter cushion of roughly $1,000 sitting in a separate account, untouched. Not a full emergency fund yet. That comes later, once bigger structural pieces are in place. This is smaller and faster on purpose. Its only job is to absorb the kind of surprise that would otherwise land on a credit card. A car repair, a broken appliance, an unexpected bill. Without this piece, every other step on this list is one bad week away from being interrupted. $1,000 is a starting point, not a fixed rule. In a higher cost of living area, or with dependents, $1,500 or $2,000 might make more sense as the actual target. A credit card can technically absorb the same surprise, and for a genuine emergency, it's a reasonable stopgap while this cushion is still being built. But it comes with interest attached the moment the balance isn't paid off immediately, which is exactly the cost this step exists to avoid paying repeatedly. Step 2. Capture your full employer retirement match, if one exists. Check your specific plan for the exact percentage, but the principle is universal. If your employer matches part of what you contribute, that's an immediate addition to your account before whatever return the underlying investments go on to earn, with no equivalent anywhere else in personal finance. Picture a plan that matches 50 cents on the dollar up to 4% of a $50,000 salary. Contributing that 4%, $2,000 a year, brings an extra $1,000 into the account immediately, just for asking. Contributing less than the full match is functionally the same as turning down part of your own paycheck. One caveat to check on your specific plan. Some employers use a vesting schedule, meaning the match becomes fully yours only after a certain number of years. Claim it either way, just confirm the exact terms rather than assuming. Step 3. Pay off high-interest debt, specifically the kind sitting on credit cards, often carrying rates north of 20%. This isn't about all debt. A reasonable rate mortgage or a modest student loan doesn't belong in this step. The math is completely different at 4 or 5% than it is above 20. Paying down a balance charging 22% gives you a guaranteed savings equal to the interest you no longer have to pay. A certainty no investment return, which is never guaranteed, can match. A $3,000 balance at that rate accrues roughly $55 in interest a month if left untouched. Every dollar paid toward it is a dollar that stops generating that cost immediately. If there's more than one high-interest balance, paying the highest rate first saves the most money, while paying the smallest balance first tends to keep people motivated longer. Either approach beats leaving all of them untouched, while money goes elsewhere. Federal student loans, specifically, often carry rates low enough that they behave more like the mortgage exception than the credit card rule. Step 4. Protect against catastrophic risks before building anything further on top of an unprotected foundation. This is earlier on this list than most checklists put it, on purpose. Everything built in the steps ahead of this one is only as secure as your ability to keep earning and keep it protected. Disability insurance. If your job doesn't already provide solid coverage, roughly a quarter of today's 20-year-olds will experience a disability lasting a year or more before retirement, a risk statistically more likely during your working years than death is, and one most workers have little or no long-term coverage against, through their employer specifically, even when short-term coverage exists. Most individual policies are built to replace a portion of income, not all of it, with a waiting period before benefits start and a specific limit on how long they last, details that genuinely differ from one policy to the next, so compare a couple of options rather than assuming any single one covers everything. If anyone depends on your income, a spouse, children, aging parents, term life insurance belongs here too, a straightforward policy that pays out for a fixed period at a much lower cost than permanent life insurance, which bundles in an investment component most people at this stage don't need. Basic estate documents appropriate to your situation, particularly if you have children, a spouse, significant assets, or people who depend on you, and confirmation that the beneficiaries listed on every account you own actually reflect your current life, not a form filled out once during onboarding at a job you may not even still have. None of this is exciting. All of it determines whether everything built in the steps ahead survives contact with the one thing you didn't see coming. Step 5. Build a full emergency fund. 3 to 6 months of essential expenses, sitting somewhere separate and slightly inconvenient to reach. Essential means the bare cost of staying housed, fed, insured, and functional. Rent, utilities, groceries, insurance, minimum debt payments, not your full current spending, including everything you enjoy. That number is usually meaningfully smaller than total monthly spending, which makes the target more reachable than it first sounds. The starter cushion from step 1 bought you time. This step finishes the job, so a real disruption, a layoff, a medical issue, doesn't force you to undo progress on any of the steps that come after it. This fund exists for one purpose: genuine emergencies. Using it for exactly that is the fund working as intended, not a failure to be avoided. Step 6, and this is where cash flow itself gets fixed, separately from the safety net around it. Get 1 full month ahead of your own bills. For some people, financial stress isn't only about how much money is coming in, it's also about this month's paycheck constantly reimbursing last month's bills instead of funding the month ahead of it. This is a distinct pool of money from your emergency fund, not a piece carved out of it. Build 1 additional month of ordinary expenses on top of what Step 5 already established. Once that additional month exists, make a single deliberate shift, fund 1 entire month from it, and let the next paycheck land untouched, becoming next month's money instead of this month's. From that point forward, every paycheck is a month ahead of what it's paying for, permanently. August saved money pays September's bills, September's paychecks become October's money, and the handoff simply keeps running on its own from there. The emergency fund stays fully intact throughout, untouched, doing its own separate job. Step 7. If you have access to a health savings account through a qualifying high-deductible health plan, use it, and treat it as an investment account, not a spending account. At the federal level, an HSA can offer a tax advantage on contributions, tax-free growth, and tax-free qualified medical withdrawals, 3 advantages nothing else on this list combines into one account. For 2026, the contribution limit sits at $4,400 for individual coverage and $8,750 for family coverage. Not every high-deductible plan automatically qualifies, so confirm your specific plan is HSA eligible rather than assuming based on the deductible alone. If you don't have access to one, skip straight to the next step. Nothing here requires it. Step 8. Increase tax-advantaged retirement investing beyond the match, a Roth or traditional IRA, and additional contributions to your workplace plan as your goals and cash flow allow. For 2026, the IRA limit is $7,500, and the 401k limit is $24,500, both slightly higher with catch-up contributions past age 50. Self-employed workers have their own versions of these accounts, generally with higher limits than a standard IRA. Good to know exists, even if it's not the focus here. Maxing every available account isn't the appropriate next objective for everyone. A home purchase, education, a business, or other near-term goals might reasonably compete for the same dollars, and that's a legitimate call to make based on your own priorities, not a rule this checklist can make for you. Whether Roth or traditional makes more sense depends on your current income and expected income in retirement. A genuine judgment call for a tax professional rather than a blanket rule, since nobody can know future tax rates with certainty. What matters more than which flavor you pick or exactly how far you push the contribution is that these accounts shelter growth from taxes in a way a regular account can't, which is why they come before that regular account on this list, not after it. Step 9. Invest additional money in a taxable brokerage account. This is what Step 8's accounts eventually run out of room for, or the right home for money meant to be used before traditional retirement age. No contribution limits, no age restrictions, complete flexibility in exchange for losing the tax advantages the accounts above it have. Money in this account is taxed on dividends as they're paid and on gains when investments are sold, often taxed more favorably at the federal level when held for more than a year, depending on your tax situation and the type of asset. A distinction to keep in mind before selling something you're not actually in a rush to sell. Step 10, and this is the step that never actually finishes. Track your net worth, not just your income, twice a year. The calculation itself is simple. List everything you own with real value, checking, savings, retirement accounts, investments, and add it up. List everything you owe, cards, loans, anything with a balance, and add that up separately. Subtract the second number from the first. That's the number. It might be negative early on, especially with student debt in the picture, and that's fine. It's a starting mile marker, not a grade. Watch the direction, not the exact figure. This is the step that tells you whether steps 1 through 9 are actually working together, or just producing the feeling of progress without the substance of it. There are really 2 ideas holding all 10 steps together, and naming them directly makes the order easier to remember than memorizing 10 separate rules. The first 4 steps protect against what could otherwise derail everything that comes after: a starter cushion, a claimed match, cleared high-interest debt, and coverage against catastrophic risk. Steps 5 and 6 build the reserves and rhythm that keep daily life stable. And running underneath the whole list is a second, simpler idea. The certain advantages get captured before the uncertain ones. An employer match in Step 2, guaranteed interest savings in Step 3, and valuable tax advantages in Steps 7 and 8. All ahead of the stock market in Step 9, which is a good long-term bet backed by history but never a guaranteed one in any single year. Step 10 simply keeps watching, permanently, to confirm the other 9 are actually working. Protect first. Capture the certain advantages next, in order. Measure forever after that. None of the 10 steps individually requires much sophistication. The sophistication is entirely in the sequence they happen in. Picture the same starting numbers: $50,000 a year, $3,000 in credit card debt, a 4% match available, handled in reverse order instead. Money goes straight into a brokerage account first, because investing feels like the priority. The match goes unclaimed because nobody got around to checking the percentage. The credit card balance sits untouched, growing by roughly $55 a month in interest, effectively canceling out a meaningful chunk of whatever the brokerage account earns in a typical year. No disability coverage exists when an injury sidelines work for 4 months, so the brokerage account gets partially liquidated at whatever price the market happens to be offering that particular week, just to cover rent. A forced sale at a moment that had nothing to do with a good time to sell, purely because nothing built earlier in the sequence was there to absorb the disruption instead. Same $50,000 a year, same span of time, a meaningfully different outcome, entirely explained by the order the same actions happened in. It helps to set realistic expectations about how long all 10 steps actually take, because the honest answer is usually years, not months, and that's normal, rather than assign anything's going wrong. Someone with modest debt and an average income might move through steps 1 and 2 within a couple of months, spend most of a year on step 3, handle step 4's insurance basics in a single afternoon once it's actually scheduled, and spend another year on step 5. The order stays the same regardless of pace. What changes is only how long each step honestly takes given a real budget, real expenses, and a real income. A few common situations change how this list gets applied, worth addressing directly rather than pretending every situation is identical. There's no single right amount to direct toward whichever step is active, either. Someone carrying a credit card balance at 28% interest might reasonably throw far more than a fifth of their income at it for a few months, while someone barely covering necessities might only manage 2 to 5% some months. And that's not doing this wrong, it's just further back on step 1 than someone with more room. Someone racing to finish an emergency fund after a job scare might push 30 or 40% toward it temporarily, on purpose. None of those percentages are more correct than the others. The goal is automating whatever amount is genuinely sustainable for the step you're actually on, and increasing it as cash flow allows. If you genuinely manage your finances as one combined household rather than separately, run the whole list against the combined picture instead. A household where one partner carries a credit card balance and the other has a fully funded emergency fund is still, as a household, sitting on step 3, not step 5. If you're self-employed or your income varies month to month, steps 5 and 6 still apply, just sized differently. The emergency fund needs to be deeper, closer to 6 months than 3, and the month-ahead buffer becomes sized to smooth out actual income variation rather than a fixed calendar gap. If you're already debt-free, step 3 simply doesn't apply. Move straight from step 2 to step 4, and the rest of the order holds. If you don't have access to an employer match at all, step 2 is skipped entirely, not delayed. If the honest math right now doesn't leave room for anything beyond covering bills, this list still applies, just at whatever pace is genuinely available. Even $5 a week toward step 1 is progress, and the goal at that stage isn't speed, it's building the automatic habit before the income to accelerate it eventually arrives. The order doesn't require a specific income level to start being true. It only requires a specific sequence, applied to whatever's actually available. Here's what that looks like walked through by an actual example. Someone earning $50,000 a year, with $3,000 in credit card debt at 22%, no savings yet, and an employer offering a 4% match. Month 1. Automate a small amount toward the $1,000 starter cushion, and contribute enough to capture the full match. Both can usually happen at once, since the match doesn't require much. Say that's $50 a week toward the cushion, reaching the $1,000 mark in about 4 months. Once the cushion exists, months 5 through 10, redirect that same $50 a week, plus whatever else the budget allows, aggressively toward that 22% balance. A few $100s a month clears $3,000 in well under a year. Once the debt is cleared, month 11, a focused afternoon on disability coverage, beneficiary confirmation, and basic estate documents, done once, revisited annually from here on. From month 12 onward, the full 3 to 6 month emergency fund gets built using the payment freed up from the cleared debt. Once that fund exists, the 1 month ahead shift happens once, using a separate pool built on top of it, permanently changing how every future paycheck behaves. From there, HSA if eligible, then IRA contributions, and a brokerage account picks up whatever's left. None of this requires a high income to start. It requires doing the steps in this order, at whatever pace an actual budget allows. You don't need specialized software to track any of this. A basic spreadsheet, or the tracking tools most banking apps already include, is enough to watch which step is active and where the numbers currently stand. The most common mistake isn't skipping a step, it's working on several at once, out of order, because all of them feel urgent simultaneously. Someone investing in a brokerage account while carrying a 22% credit card balance is paying to invest. The card's interest is quietly outpacing whatever the investment is earning. Someone building a 6-month emergency fund while turning down a full employer match is protecting against a disruption while leaving free money unclaimed the entire time. The order exists because each step either removes a risk the next one would otherwise be exposed to, or captures an advantage that's cheaper to claim now than later. The second common mistake is treating this as a list to finish once and forget. Steps 1 through 9 build a structure. Step 10 is the only one that never actually ends. Incomes change, debts get paid off and sometimes return, insurance needs shift when a family grows, and beneficiary forms get filled out once during onboarding and then never looked at again for a decade. Revisit the whole list about once a year. A birthday works well, since it's a date you're unlikely to forget. And again, after any major life change, specifically a marriage, a new child, a home purchase, or a significant income shift, since those are exactly the moments Step 4's coverage amounts and Step 10's whole picture are most likely to have quietly drifted out of date. Most years, nothing needs to change. That's not wasted time. That's the whole point of checking. The third common mistake is treating each step as a decision to make manually every single payday, instead of a decision made once and automated, and then abandoning the whole list after a single setback. A car repair that dips into the starter cushion doesn't mean Step 1 failed. It means Step 1 did exactly the job it was built for and now needs to be replenished before moving on. Automate whatever step is active, let it run without requiring a fresh decision each payday, and treat a single interruption as exactly that, an interruption, not a reason to stop following the order altogether. If you've made it through all 10 steps, or you're partway through them right now, the honest answer to "what should I do next?" was never actually complicated. It was just buried under advice that never told you what order any of it belonged in. Now you know. Pick whichever step you haven't finished yet, and start there. Go back to the reverse order scenario from earlier. The unclaimed match, the credit card quietly growing, the brokerage account liquidated at the worst possible moment because nothing was protecting it. That wasn't a story about someone earning less or investing worse. It was the exact same $50,000 a year, moving through the exact same list of actions in a different order. How much money you have to work with still matters. That was never in question. It's just not the only lever, and it isn't the one this checklist is about. The order it moves through is doing real work too, and it's the one lever that costs nothing extra to get right. For a fast recap, in order, a starter cushion, the full employer match, high-interest debt, protection against catastrophic risk, a full emergency fund, getting 1 month ahead on cash flow, the HSA if you have one, tax-advantaged retirement investing, a taxable brokerage account, and net worth tracked twice a year for the rest of the time you're managing money at all. 10 steps, 1 order. Everything after that is just detail.